This is Matthew Cratter from Trader University, and today I want to answer the question, will the slowing economy crash stocks? As part of this, we're going to be talking about the Federal Reserve and the taper. This is the Fed's balance sheet. They've been growing it explosively really since the beginning of the pandemic. What the Fed does is they print money, they buy mortgage-backed securities, they buy government bonds called treasuries, and they add them to their balance sheet. And in this way, they monetize or pay for government deficit spending. So something very interesting has been happening in the past month or so. And one way to look at it is to follow one member of the Federal Reserve, the Atlanta Fed, whose last name is Bostic. He's been urging a much faster bond taper. So again, a taper is when the Federal Reserve slows the rate of purchasing these securities. And whenever it does do that, or whenever it tries to shrink its balance sheet, it makes stocks go down. This is what happened in 2018. We had a crypto crash and we had a stock crash because the Fed was shrinking their balance sheet right here at the end of 2018 and early 2019. So Bostic has been urging the Fed to taper, to slow the rate of their purchases of these securities. That he's been saying the economy's been strong and needs to be able to stand on its own. So that was August 9th. August 27th, he was saying, let's start the taper and do it quickly. And he's basically been saying, we've been at a very extreme level of accommodation. The economy calls for us to pull off of that a little bit and let the economy stand on its own. As we'll see, letting the U.S. economy stand on its own is sort of like letting a heroin addict stand on his own. As long as there's unlimited money flowing, it's possible, but it usually ends fairly badly. So Bostic has been what we would call a hawk. He's been pushing for higher rates and tapering of the Fed's balance sheet. But a funny thing happened just 2 days ago. Bostic on September 2nd actually said that he thinks now the Fed should let the economy run until it sees inflation. And if you're used to reading the tea leaves of Fed speak, you'll understand that this means he is turning much more dovish. Now, what happened on September 2nd? Well, he must have seen the jobs numbers ahead of time. Obviously, government officials like him have access to this. And the jobs report was extremely disappointing yesterday, September 3rd. They're expecting 235 positions added. They're expecting 720,000 positions added, and only 235,000 new jobs were added in terms of non-farm payroll numbers. So what does this mean? Well, before I explain that, if you're finding this video helpful so far, be sure to hit that subscribe and like button. So we basically have Bostic going from being very hawkish to being very dovish and saying, well, maybe we should hold off on the tapering. What other data is he looking at? Well, he's obviously looking at GDP estimates. A really good center for this, a good website for this, is the Atlanta Fed, where Bostic is, their own website. You can look at their projection here. It's called GDPNow. And what this does is it looks at the current quarter and it does an economic model that estimates real GDP growth. So what we're looking at now would be the third quarter of 2021. The latest estimate for growth, an annualized growth rate for this quarter, is 3.7%, which sounds fairly healthy until you realize where this estimate and where the model has been trending. This again is from the same website. I'll link to this below. As recently as July 30th, the GDPNow model was estimating annualized growth in the third quarter of 6.1%. It accelerated to 6.3%, and then it's been declining very rapidly for all of August. By the end of August, it had dropped down to 5.1%, and now, based on the September 2nd economic numbers, and again, it only uses numbers that have been publicly released, the GDP, real GDP growth on an annualized basis for the third quarter of 2021 has been revised down to 3.7 from 6.1. This is presumably what is making Bostic and presumably other Fed members pull back on the idea of tapering or slowing their purchase of bonds and other securities. Harold Malmgren has an interesting take on the taper here, even from a couple weeks ago. He was pretty ahead of his time, and he's one of these guys who's been in Washington, D.C. for 50 or 60 years and really knows a lot of people. The tweet is Fed, and I believe this should be reality. Fed reality-based monetary policy outlook. No taper before decision on the Fed chair. Powell is widely expected to be renominated as the chair of the Federal Reserve, but that hasn't been decided yet. Then the dynamics of midterm congressional elections, which happen next year. No taper until after midterm votes, thus no taper until 2023. This is very non-consensus on Wall Street, but I think it's probably true. And whenever Malmgren says something, it really pays to listen to him. In a separate tweet, a more recent tweet from August 30th, Malmgren saying that he believes that Powell will soon start a whole new round of money printing, a new surge of $3 trillion worth of money printing, simply because this is how much the U.S. government, the federal government, spending, and they need to get the money from somewhere. They can't get it from taxes, so the Fed has to print it up for them. Growing consensus that Biden's stimulus package won't pass. This is presumably the infrastructure bill, which we'll see what happens to that when the House of Representatives returns in mid-September. Number two, in Malmgren's tweet, demand in the U.S. economy will sag without action. This is an economy that's really on a sugar high, and it's functioning basically just based on stimmy checks and Federal Reserve stimulus. So I think this is right. And as these stimmy checks have sort of been phased out for a lot of people, we've seen what's happened to GDP estimates going from over 6% down to below 4%. So we have a very strange situation here that's actually been the way the Fed has been working and monetary policy has been working in the U.S. for really, call it 10 to 15 years. It's a little bit like this Macbeth quote, fair is foul and foul is fair. Slower economic growth is not really good for anyone. It's no fun to lose your job. It's no fun to have a recession, etc. But the slower economic growth is the lower probability of the Fed being able to taper and or raise interest rates. The slower economic growth is, the slower projected GDP growth is, the higher probability of more money printing and Fed balance sheet growth. So rather than having some sort of taper where this line pulls back, we're actually projecting something more like that. That's what Malmgren is projecting as well. And stocks like this. So in a sense, foul is fair. When you get slow economic growth, it means the Fed can keep its stimulus going and its money printing going. Stocks and Bitcoin like this and choose to go higher. This is really what's been happening. The stock market has been almost straight up the entire year with very, very shallow pullbacks. And I think the market has figured this out even before a lot of Wall Street analysts and macro analysts at the investment banks, seeing that the economy is slowing, and so the Fed is going to have to keep their money printing going. Of course, the problem with this is it's all artificial. We all know that. Without this money printing, the U.S. would be in a very, very deep recession, possibly a depression. But austerity, default, these are not options. A recession is not an option because that makes tax revenues go down even more, because if the stock market goes down and the housing market goes down, capital gains taxes go down as well, and people feel poorer as well, and so consumer spending goes down as well. The real escape valve for all of this is not going to be a stock market crash. The Fed's going to need to continue to print probably for the rest of all of our lives, certainly for the next decade or two or even more. Meanwhile, the purchasing power of the US dollar, we're not talking about its exchange rate with other currencies, other fiat currencies like the euro or the yen or the Australian dollar. We're talking about its purchasing power, how it is able to buy real things in the real world. If you've been to the grocery store lately, if you've been shopping for a house lately, if you've been shopping to buy some stocks lately, you see that the purchasing power of the dollar continues to decline. This is a chart that shows the purchasing power going from about $26 when the Fed was started in 1913, all the way down to $1 worth of purchasing power for a single dollar. So this shows this is the real escape valve. This is what happens when you print too much money. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.